Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're breaking down who performed better in the last quarter. Goldman Sachs GPIX, which is the premium income ETF for the S&P 500, or the NEOS S&P 500 high income ETF SPYI. Both of these we put up head to head numerous times, and these are two very, very strong pieces. So the question is, who actually is best performed in the last quarter? And looking out to the rest of the year, which one of these do you want in your retirement portfolio? We're going to break them down for you and give the information that you requested. So grab your favorite mug, put your favorite beverage inside of it, sit back, relax, and let's take a little journey. Who is better, GPIX or SPYI? Now, the disclosure of this presentation for educational purposes only is not financial, legal, or tax advice. Past performances do not guarantee future results, and I am not a financial advisor. Hey guys, before we go any farther, if you don't already have one of our favorite mugs, our 11 ounce or our 15 ounce Big Daddy, don't be afraid. You can order them right now. They're shipping out as we speak. Hit the QR code, hit the links down below. This is what helps support the channel. This is the biggest thing. We have Patreon, which does phenomenal, which is awesome if you need one-on-one training or one-on-one help with your portfolio. Or we do the coffee mugs and the license plates and travel mugs that really help the channel keep doing what we're doing. If you haven't supported it, thank you so much. If not, don't be afraid. Order one today. So we're doing a 90-day test. And the question is really, why am I doing a 90-day test? We can break this down year by year, but we're really starting to really put this under the microscope and say, hey, who's doing what, who's doing where in the past 90 days with the market conditions that we're facing. And we see the conditions pretty much staying the same lately. So it'd be a good thing to test. So May 6th through August 4th, we put this on the calendar, 90-day window. Let's find out what is going on with this one. We're going to look at yield, current and trailing distribution rates. We're going to look at cash income, the distributions paid in the period. We're going to look at the growth, and we're going to, of course, look at total returns because that's how I look at funds across the board. Always total returns first. It's taking a look at what the fund actually is doing and how it's performing. Because the headline yield is not total return. We separate the paycheck from the portfolio results because in retirement, we're building a paycheck, not working for just the biggest yield possible. So, same market, two different engines giving us two totally different results. SPYI is the high income focus. And you guys will know this from the past. They have built this thing for income generating with upside potential. So they do the S&P 500 equity exposure. They use the SPX index options. So they're using a S&P 500 index, which allows them to participate in the tax efficiency side of the 1256 contracts. And they generate higher monthly distributions in their portfolio. Now, GPIX, the Goldman Sachs side of it, is built on income, but more focused on upside. So we always say this is a balanced approach. It uses the S&P 500 equity exposure and then uses a dynamic option overlay. Now, what is a dynamic option overlay? Well, if you follow the channel, we've explained this, but I'll be more than happy to right now. And that is, they take their portfolio and they do what I call a 25-75 program, which is if the market conditions are growing and things are going strong, we can see the markets increasing, they will actually do 25% of their portfolio will be covered selling call options, leaving 75% of the market wide open. Now, if the markets get bouncy, if they get into the volatility, if they start getting rough waters, they will actually switch it and go up to a 75% coverage to generate more income because you're getting ups, downs, ups, downs. They're going to cover it to get more income across the board. So it's a very targeted design to generate income and growth at the same time. There's a lower targeted distribution rate. So they're not shooting for this big elaborate number. They're shooting for a total return package. So why I like GPIX so much is that is the first thing they talked about in their conference call was doing a targeted distribution rate. So there's more room for sharp price appreciation across the board. So round one, the distribution yield. Now I'm going to throw this in here just to give you guys, because I get a lot of comments if I don't do this the right way. And you're always welcome to put comments down below. It actually helps the channel, and I love hearing what you guys have to say. But SPYI, NEOS, has an official distribution rate of 12.04% up to the close of business on July 31st. The trailing 12 months is 11.94. So within about a 0.1 percentage points over the 12-month period versus just using the since July. And then GPIX has a trailing 12-month rate of 8%. So realistically comparison, we're looking at 11.94% to an 8% over the past 12 months. So you can see SPYI is definitely trailing to that higher number and creating higher income rate across the board. Now you're talking about a 4% difference, which is huge. 4% is large into this category. But when we take a look at the actual cash income, like I told you, the past 90 days, things look a little different. SPYI generated in the past quarter 2.95% versus GPIX generated 2.09%. So the percentages look low, but realistically, we're still within that about that 1 percentage rate per month from SPYI, and we're basically below that 1 percentage point with GPIX. Now here's the other big thing to look at. SPYI paid out approximately $1.59. I round it to $1.60 a share. And GPIX is approximately $1.18. So realistically here, $1.60 versus $1.18. I don't even care about the percentages. I just know I'm getting $1.60 per share. That's 39% more cash per invested dollar during this quarter. So if you're looking at income window, you're looking for income in your portfolio, I mean, SPYI is crushing it compared to GPIX. This is why this is such a strong piece in so many portfolios and why I make sure it's in most of mine. Now, number two, the share price. Now, as a retiree, and I've been retired for 10 years now, I don't always go after the growth side of it because I want the income. I need income. I need to pay my bills. I need to live. I need to do my travels. I need to do stuff that you want to do in retirement. Now, you got to have some growth because you got to have inflation's going to change things. You got to keep your portfolio maintained and well balanced. So when we take a look at this, in the past 90 days, SPYI's price has gone up 1.58%. So it's gone basically from $53.20 to $54.04. Now GPIX, the price has grown 2.91%. From $54.64 to $56.23. It's almost like I just flipped the script. Okay? You're getting almost 1% of growth from GPIX. And you're basically getting 0.5% from SPYI. So this makes a huge difference if you're looking to make up some improvements and catch up on your funds, that the growth pattern is extremely strong when we talk with GPIX. Now, round three is our total return. Now, in the past estimated 90 days total return, when we put everything under the microscope, you would see a $10,000 investment to either one of these funds. SPYI would generate you $467. GPIX would have generated $512. So there's a $45 gain by having it in GPIX. But remember that gain is from growth, not from income. So when we take a look at total returns, 4.67% for SPYI, 5.12% for GPIX. So right off the bat, you want to say total return is the way to be, right? So you want to say GPIX. But I always got to put an asterisk there. What if you need income? how are you going to play the game for income? So when I do the scorecard, the trailing yield is SPYI. The 90-day cash income is SPYI. The share price growth GPIX, total return GPIX. So this is a split decision. It's right down the middle. It's basically the bottom line, income versus growth. Now, am I saying GPIX doesn't have income? No, it's about 2.16% approximately. SPY is 3%. When you get the growth, does SPY not have growth? Sure, it has 1.58% versus 2.91%. So you can see the magic blend is GPIX with the magic 5.12, but that's only 0.6%. So virtually just a hair under 0.5% difference between the two funds. So why did GPIX win the total return game? Is because it had more upside participation. SPYI had the higher distribution, okay? We give that to them. They are going to generate more money. But when you look at your portfolio balance, GPIX will win because of the upside participation. So you have to ask yourself, what do you want? Income or growth or a little bit of both? And that's why GPIX comes right in the middle, I call it, between the two. So which is better for retirement? Now, I always laugh at this question because I get this all the time. And I don't laugh because it's funny. I laugh because so many people think it's a decision of A or B. And I always come back with C, combination. So in your income bucket, you may choose to put SPYI as your core item because you need that more monthly cash flow. You plan to spend your distributions and you can accept that the lower upside of your portfolio. Now that number can bury a lot of people. They don't like having their portfolio not growing. Because for 30 years, we've always said, grow, grow, grow. Invest your money, grow your portfolio, get the biggest portfolio you possibly can. But when we take a look at this and say, you need income in retirement, you need to be able to buy and pay for everything you want to do. You do not want to just sit back and say, I'm good enough. This is why the balanced income and growth side of it choose GPIX. They're getting some income, not as much as NEOS. So they're not the maxed out yield, but they are getting some NAV growth, which matters to them, and more market participation. So going back to the question, who do you pick? Income or the balanced approach? Well, my answer to you is, why can't you pick both? And this throws a lot of people like, what? In an income bucket, you normally have a core and what we call a satellite. Satellite will support what the core does not achieve. So let's do it this way. I'll take GPIX because of the nice growth and it has some income. Now I put SPYI, which will boost our income to a higher number. Working the two together in one portfolio makes much better sense. And we're not relying on only one company, but we're relying on two separate strategies, designs, and hopefully different outcomes. So my final verdict comes this way. If you want to do it by category, income, NEOS. Growth, GPIX. Total return really is GPIX. The biggest distribution did not produce the biggest total return. And when we take a look at that, GPIX is 5.12% total return versus 4.67% of NEOS. It's a close race, and it's not a permanent conclusion. But what if you put the two together to create what I call that special sauce? Put those together, boost your income, cover your growth, and together, I think you have a much better, stronger total piece of blending these two together versus not. If you like my idea, put a comment down below. I'd love to hear from you. Maybe some of you are doing it this way. A lot of my Patreon people that I work with in their portfolio, This is exactly what I do with them. I mix the two together and I show you that you're really collecting between the two about a 9.7% total return over the past 30 days. So let me know your thoughts. Leave the comments down below. If you like what we're doing, hit that like button. And most of all, thank you so much for watching our videos and supporting our channel. If you don't have your mug, what are you waiting for? Go order one. The 40 ounces have been really doing well. You'd like it with the travel mug. I catch you on the next video. We'll see you later.